Okay, Dallas crew. I wanted to send out an update video. This time around we're going to be talking about intraday kinds of trading. Really, intraday trading, it seems from a couple of the webinars, it really does seem like the feeling out there for some traders is that, hey, if I trade intraday, then the risk is lower. And hopefully you've reviewed the November 26th webinar where I discuss some of these concepts of risk and what does risk mean, how do you plan for risk, and what truly is risky. Okay, because the one risk that most traders miss when it comes to intraday trading is the risk of increased number of transactions. Just by the very nature of intraday setups, you're going to come across more of them in any given 24-hour, 48-hour, or weekly time frame. So you've got to be prepared for the increased activity. And in that webinar, what I showed you was using an intraday setup, how over the span of about 3 days, you would encounter you would have encountered 3 losing trades and then one big winner, which would have made up for it. So again, you've got to understand that with intraday trading, it can be very, very risky. And you've got to realize as well that as we start talking about some of these simulated trades and some of the income potential here, past performance doesn't guarantee future results. And these are hypothetical results only. Due to the nature of the Forex, your price, feed, and chart setups can and more than likely will be different. Okay, so let's take a look now at the 15-minute bar. And the reality is, if you wanted to, you could even use the dreaded 5-minute bar. Now, the concept is still the same. Okay, the concept being, we're looking for the weave, and then we're looking for a hand. Now, the beauty of using this particular technique is it will keep you out of trading in this area. Okay, let's say you are looking at this really short-term time frame. Okay, this is 5 minutes. Today is the 11th of December, and this is from early in the morning Eastern Time until current market hour, which is just after 1 o'clock. Now remember, when I say weave, what I'm talking about is an area on the chart where you can see the moving averages crossing and blending together over a very short period of time. Okay, now just note the difference here between the moving averages here and then the moving averages anywhere along this timeline. So for several hours, even though the market was moving fairly sideways, it wasn't until between 7 and 9 a.m. Eastern that the market truly started to weave. Now once you see the weave pattern start to begin, and let's go ahead and zoom in so we're really clear on what we're talking about. You can see here that the red moving average crosses once, twice, very quickly, but more importantly, you can see how close the moving averages are to each other. And that's really the key here, is that your moving average will start to get very, very close to each other and weave together. When you see the moving averages separating, like you can see here, all you're witnessing is a trend on whatever time frame you're looking at. Yes, even on a 5-minute. On a 5-minute chart,